advanced financial reporting, and our topic today is external reconstruction. So when we talk about the external reconstruction, we normally say that this is where the existing company is wound up. This is where the existing company is wound up due to financial problems. This is where the existing company is wound up due to financial problems and its business taken over by the existing or the new company. So we can say that external reconstruction is where the existing company is owned up due to financial problems and its business taken over by new or existing company. This is where the existing company is wound up due to financial problems and its business taken over by a new or existing company. And remember, you cannot reconstruct a company if it is not making what? If the company is not making losses. If the company is making profit, we are not going to do what? To reconstruct. We only reconstruct a company that is making losses. So, in this case, in case of the takeover, the purchase consideration, in case of the takeover, the purchase consideration need to be determined. In case of the takeover, the purchase consideration need to be determined. In case of the takeover, we need to determine the purchase consideration. And the purchase consideration is determined as follows. So purchase consideration is determined as follows. This is how we are going to determine the purchase consideration. So the purchase consideration number one, it is going to include the amount payable to who? To ordinary shareholders. To ordinary shareholders. The amount payable to ordinary shareholders. Number two is going to be determined by including the amount payable to preference shareholders. Amount payable to preference shareholders. Then number three, we have the amount payable to debt holders or debenture holders. And also we can talk about the reconstruction cost, or what we call the liquidation expense. So when we talk about the liquidation expense or reconstruction cost, this reconstruction cost is treated as a preliminary expense. And this preliminary expense should be capitalized. So these are the amount. This is how you are going to determine the purchase consideration. You'll be taking the amount payable to ordinary shareholders, you take the amount payable to preference shareholders, you take the amount payable to debenture holders, and also you take the reconstruction cost. The reconstruction cost. Then the next step, we are supposed to prepare the accounts. The accounts. Let us look at the accounts prepared. Accounts prepared to close off the books. To close off the books of account. To close off the books of account of existing company. So which accounts are we going to prepare to close off the books of account of existing company? One of the accounts that we are going to prepare is for the owners of the existing company, who are known as the ordinary shareholders. Ordinary shareholders, sundry members account. That will be the first one. Then the second account, we are going to talk about the preference shareholders, sundry members account. Then number 3, we will talk about the debenture holders account. Then number 4, we talk about the purchasing company account. And finally, number 5, we are going to prepare the realization account. So these are the accounts which are prepared to close off the books of account of existing company. You need to know how to prepare the ordinary shareholder sundry members account, preference shareholder sundry members account, debenture holders account, purchasing company account, and realization account. Then let us look at the journal entry to open the books. Let us look at the journal entries. Journal entries to open the books. Of the new company. Journal entry to open the books of the new company. Journal entries to open the books of the new company. The journal entry number 1. We are going to talk about the assets taken over. So to record, let us talk about to record the assets taken over. How are we going to record the asset taken over? The journal entry, remember the journal entry from your foundation level, we say it has a debit and credit. So therefore, in this case, we are going to debit the individual asset account as we credit the business purchase account. So that is the journal entry to record the asset taken over. You are going to debit the individual asset account as you credit the business purchase account. Then the next account will be to record the liabilities taken over. To record the liabilities taken over, and when you are recording these liabilities taken over, the opposite of the asset. So it will be, you are going to debit the business purchase account. You debit the business purchase account as you credit. What are you going to credit? It is the individual liability account. Then number 3 is to record to record goodwill, to record goodwill or capital, to record goodwill or capital reserve. Remember, the negative goodwill is what we refer as capital reserve. The negative goodwill is what we refer as capital reserve. So let us start by looking at the goodwill. How are we going to record the goodwill? In case of the goodwill, we are going to debit the goodwill account as we credit the business purchase account. Then for the case of the negative goodwill, or what we call the capital reserve, you are going to do what? You will debit the business purchase account as you credit what? In this case, you are going to credit what we call the capital reserve. And this capital reserve is an equity item. This capital reserve is an equity item. This capital reserve is an equity item. Then from there, we talk about number 4, to record the purchase consideration determined. So to record the purchase consideration. To record the purchase consideration. How are you going to record the purchase consideration in this case? You are going to do what? You are going to debit the business purchase. You will debit the business purchase account as you credit what? As you credit the vendor's account. So those are some of the journal entries to open the books of the new company. We have the asset taken over, liabilities taken over, goodwill or capital reserve, and also the purchase consideration. So this is all about the external reconstruction, and once you understand all this information, to adjust in any question of external reconstruction, it is going to be very easy. So I want us to look at one of the illustration in our past papers, Advanced Financial Reporting, past papers. So we can look at one of the illustration and see how we can adjust any question of external reconstruction. So let us look at illustration, and the illustration that we will look at is from December 2022, question number 5. So December 2022 Advanced Financial Reporting, December 2022, question number 5. December 2022, question number 5, that is the question I would like us to go through. And this is what we are told in this question. Question number 5. Question number 5, you are told that Taidi Limited, a private limited company, has been in financial difficulties and has reported trading losses for a number of years. The directors of the company invited the shareholders and creditors for a special general meeting where it was resolved that the operations of Taidi Limited be transferred to a new formed company, Stawi Limited, with effect from 1st August 2022. The latest statement of the financial position of Taidi Limited as at that 1st July 2022 was as follows. You are given the asset, non-current asset, we have the property, plant and equipment. Also we have intangible assets. Into bracket, they are talking about the brand. Current asset, we have inventories, account receivables. Equity and liability, for the case of the equity, we have the ordinary share capital, 10% irredeemable preference share capital, share premium, retained earnings, into bracket losses. Then for the case of the non-current liabilities, we have 12% bond. Current liability, account payable, accrued interest on bonds, bank overdraft. Additional information, number 1, you are told that the newly formed company authorized share capital comprises 5 million ordinary shares of shillings 10 per value each. Number 2, Stawi Limited issued 4 new ordinary shares of shillings 10 each, credited at shillings 5 each for every 2 preference shares held in Taidi Limited. The preference shareholders agreed to immediately pay the balance on the shares allotted. Number 3, the preference dividend in Taidi Limited were 2 years in arrears. Half of the preference dividend arrears were settled by issue of fully paid ordinary shares of shillings 10 each in Stawi Limited. Number 4, you are told that the new company also issued 3 new ordinary shares of shillings 10 each, credited at shillings 5 each for every 5 ordinary shares held in Taidi Limited. The ordinary shareholders agreed to immediately pay the balance on the shares allotted. Number 5, the bondholders in Taidi Limited agreed to be transferred to the new company on condition that the bonds would be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bond was to be 8% per annum. Similar bonds with no conversion rights attract interest at the rate of 10% per annum. Accrued interest on the bonds was to be paid immediately upon takeover. Number 6, the current liability of Taidi Limited were transferred to Stawi Limited at their book values. Number 7, the brand was considered valueless and therefore written off. Number 8, the tangible assets were taken over by Stawi Limited at their fair values as follows. Property, plant and equipment, inventories, account receivable. Number 9, liquidation expense of Taidi Limited amounted to shilling 6 million and were settled by Stawi Limited. Number 10, immediately upon takeover, Stawi Limited invited its ordinary shareholders for 1-for-5 right issue of ordinary shares at an exercise price of shillings 15. The average market price of the ordinary shares on the come right basis immediately before the right issue was shillings 20. The issue was fully subscribed. Now the examiner requires number 1, the following ledger accounts to close off the books of Taidi Limited. The examiner requires realization account, number 2, preference shareholders sundry members account. Number 3, ordinary shareholders sundry members account. Part B, journal entries in the books of Tawi Limited to record the initial recognition of the 8% convertible bond and the right issue on 1st August 2022. And finally, opening statement of the financial position of Tawi Limited as at 1st August 2022. 1st August 2022. So those are the requirements. And for you to do any question on external reconstruction, the first step, ensure you start with determining the purchase consideration. So the first step will be for us to determine. We are going to determine the purchase consideration. Purchase consideration. Before we can answer any question, the first step is for us to determine the purchase consideration. Our shillings are given in 1,000. So let us see what we are told by the examiner. Number 1, additional information. Additional information number 1, you are told that the newly formed company authorized share capital comprises 5 million ordinary shares of shillings 10 per value each. That will not help us to determine the purchase consideration. Then we go to number 2, Tawi Limited issued 4 new ordinary shares. So in this case, we are talking about the Tawi Limited. Tawi Limited, remember, is the new company to be formed. It issued 4 new ordinary shares of shillings 10 each, credited at shillings 5 each for every 2 preference shares held in Tahidi Limited. So therefore, number one will be preference shares in Tahidi. So these preference shares in Tahidi were converted to ordinary shares in the new company. How many shares did we have in Tahidi Limited preference? So when you go to the statement of financial position, you are told 10% irredeemable preference share capital. The par value you are given 10 and the share capital you are given is 10,000. So you take 10,000, you divide by 10. So in this case, we are talking about 1,000 shares. 1,000 shares. 1,000 shares. Then let us continue and hear what the examiner is saying. They were given ordinary shares in the new company. So they were given ordinary shares. They were given in Tawi Limited. How are they allotted these ordinary shares? We are told that they were allotted, they were given 4 if you had 2 preference. And how many shares were in total preference? They were 1,000. 1,000. And therefore, the company decided to pay how much for them? We are told that shillings 10 each, credited at shillings 5. So the company decided that it will pay 5 shillings for them. 5 shillings for them. So therefore, how much did the company pay for them? How much did the company pay for them? So in this case, it will be very easy. You are going to take 4 over 2. Then 4 over 2 you multiply by 1,000, you multiply by 5. So in this case, the company decided that it is going to pay for them how much? It is going to pay for them 10,000. The company will pay for them 10,000. Then the remaining balance was to be paid by the shareholder in form of what? In form of cash. The remaining balance was to be settled by the shareholders. So if we pay, remember the par value is 10. The par value is 10. The company has paid 5 per share. So the owners are also going to pay 5 per share. So also the owners are going to top up by how much? By 10,000. By 10,000. Get that point clear. Then let us go to the second information. Number 3. You are told that the preferred dividend in Tahidi Limited were 2 years in arrears. So number 2, we are going to talk about what? Number 2, we are going to talk about the preference. Preference dividend. Preference dividend in arrears. Preference dividend in arrears. Let us compute those preference dividend in arrears. How do we compute the preference dividend? It is very easy. We normally take the interest rate, then we multiply by the share capital. And when you go to the equity, 10% irredeemable preference share capital, you are told the total amount is how much? The total amount is 10,000. So it will be 10,000, you multiply by 10%. You multiply by 10%, and when you take that, you multiply by 10%. In this case, you are going to have the preference dividends of how much? Of 1,000. 1,000, that is per annum. But they were 2 years in arrears, so the total amount will amount to 2,000. 2,000. That is the preference. Then, other than that, the examiner continued to tell us that half of the preference dividend in arrears were settled by issue of fully paid ordinary shares. So a half, we are told that half they were given what? Half they were given ordinary shares. Half of preference were given ordinary shares in Stawi Limited. So a half of 2,000, so the company gave them a half, which is 1,000. 1,000. There is no cash that was added in that case, no cash that was added in that case. Then let us go to the next note. Next note is note number 4. Note number 4, you are told that the new company also issued 3 new ordinary shares. The new company also issued 3 new ordinary shares of shillings 10 each, credited at shillings 5 each, for every 5 ordinary shares held in Tahidi Limited. Tahidi Limited. So number 3, we are going to talk about the ordinary shares. Ordinary shares in Tahidi. Ordinary shares in Tahidi. How many shares were in Tahidi? Let us get them. So the ordinary shares, share capital, you are given 20,000. The par value is 10. So you divide by the par value, so therefore you will get the ordinary shares worth how much? 2,000. 2,000. Then these ordinary shareholders in Tahidi Limited, they were given ordinary shares. They were given ordinary shares in Stawi. In Stawi Limited. They were given ordinary shares in Stawi Limited. How are they allotted these shares? They were given 3 if you had 5. They were given 3 if you had 5. So 3 for every 5. And the total shares were 2,000. And the company decided to pay for them how much? Again 5. The company paid for them 5 shillings. So therefore, how much did the company pay for them? How much did the company pay for them? So in this case, it is 3 out of 5. Then you multiply, it is 3 out of 5. Then you multiply by 2,000. Then you multiply by 5 shillings. So the company paid for them 6,000. The company paid for them 6,000. Then from there, the examiner is telling us that the ordinary shareholders agreed to immediately pay the balance. So the company paid a half, and the balance was to be settled by the owners of the shares. The owners of the shares. That is what we are told in number 4. Then we go to number 5. Number 5, we are told that the bondholders in Tahidi Limited agreed to be transferred to the new company on condition that the bond would be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bond was to be 8% per annum. Similar, bond with no conversion right attract the interest at the rate of 10% per annum. Accrued interest on the bond was to be paid immediately upon takeover. This is a financial instrument. This is a financial instrument. And when we talk about the financial instrument, we normally say this is a contract. This is a contract which will give rise. Is a contract which will give rise to a financial asset to one party and a financial liability to another party. So for the financial instrument, they agreed to be transferred to the next company, Starway Limited. So they were not part and parcel of what? They were not part and parcel of the purchase consideration. So let us go to the next note. The next note, number 6, the current liabilities of Tahiti Limited were transferred to Starway Limited at their book value. Again, these liabilities were transferred to the new company. So they were not part and parcel of what? Of purchase consideration. Then number 7, the brand was considered valueless and therefore written off. So again, the brand was considered valueless and was to be written off. So where are we going to write this intangible asset off? It will be written off where we are going to have the ordinary shareholders sundry members account. There is where we write off. In case if the examiner can tell you that the goodwill was considered valueless, also it will be written off in the ordinary shareholder sundry members account, because you will never get that amount. Then from there, we go to number 8. Number 8, you are told that the intangible assets were taken over by Starway Limited at their fair values as follows. Then number 9, you are told that the liquidation expense of Tahiti Limited amounted to shillings 6 million and was settled by Starway Limited. So this one, we talk about it. Number 4, we have what we call the liquidation expense. Liquidation expense. Liquidation expense was how much? The liquidation expense in this case was 6. The liquidation was 6 million. 6 million. 6 million. And was settled by Starway Limited. And finally, they are talking immediately upon takeover. Immediately upon takeover. So let us get the purchase consideration. So the purchase consideration will be how much? The purchase consideration will just add. So it will be 10,000 plus 1,000, that is 11,000, plus 12,000, it will give us 23,000. So we are getting 23,000. So how much did the shareholders pay in form of cash? In form of cash, they paid 10,000 plus 6,000. They paid a total amount of 16,000. 16,000. That's the first step. You need to get the purchase consideration. Once you have the purchase consideration, once you have computed the purchase consideration, now you can go to answer the question. The question now will be very easy. The first question, A, they want the realization account. We can open those accounts concurrently. So, the part A, they need us to prepare the realization account. Realization account. And this is one of the account to close off the books of an account. The realization account. Remember, it's a requirement. Our shillings are in what? In thousand. Our shillings are in thousand. Then, this is the Roman 1, realization account. Then Roman 2, they need us to prepare which account? They need us to prepare the preference shareholders and members account. We have preference shareholders, sundry members account. So this is how we are going to prepare the preference shareholders sundry members account. Again, this is a requirement. Preference shareholders sundry members account. Then Roman 3, they need us to prepare the ordinary shareholders sundry members account. Ordinary shareholders sundry members account. This is how we are going to prepare this account. They are very easy account. Shillings are in thousand. Shillings are in thousand. So this one, so we start with these two because they are very easy. So here we are going to have the balance brought down. Balance brought down was how much? The balance brought down, you go to the statement of financial position, and the balance brought down for that, you are given 10,000. This is 10,000. Then here we can put our balance brought down again. The balance brought down here is how much? Ordinary shares, statement of financial position, 20,000. We have 20,000. We have 20,000. Then for this, we have the preference dividend. Preference dividend. So the preference dividend were 2 years in arrears. How much were they? 2,000. So here we have 2,000, the preference dividend. Then from there, these preference shareholders were converted to ordinary shareholders. So if you look at the note number 1 that we have here, preference shareholders in Tahidi Limited were converted to the ordinary shares in Stawi Limited. Worth how much? Worth 10,000. And when you go to number 2, is that the preference dividend in arrears, half of it was converted to ordinary shares. So let us get the total ordinary shares, new ordinary shares in what? In Stawi. In Stawi. Well, worth how much? We have said it is 10,000 plus this 1,000 half. So here we have 11,000. 11,000. Then from there, we go to the ordinary shareholders. Ordinary shareholders, if we have the share premium, we include it there because we are writing off. So we have the share premium. So we had the share premium. Share premium was how much? Share premium, I can see it is 2,000. It is 2,000. Then also it will be affected by the retained earnings. Retained earnings, remember it's a loss. Remember we said we cannot reconstruct a company that is making profit. So we have retained earnings. Retained earnings, which are losses. You debit how much? They were 58.90. Then other than these retained earnings which were losses, we have what? We talked about the brand. The brand was how much? The brand was 4,800. The brand was 4,800. And then also these shareholders in the new company, they were given ordinary shares. Ordinary shares. Ordinary shares in Stawi. Stawi in Stawi. They were given ordinary shares in Stawi. Let us go to the ordinary shares. It is note number 3. Note number 3. Note number 3. Ordinary shares in Tahidi. They were given ordinary shares in Stawi Limited. Worth how much? Worth 6,000. 6,000. Then from there, I think there is no more information. We can balance our account. We can balance our account. We can balance our account. We can balance our account here. So before we balance, now let us go back to the realization account. So for the realization account, it is very easy. Here, you normally take the assets taken over. But these should be at the net book value. Asset taken over at the net book value. And in this side, we start with the liabilities. Liabilities taken over. Liabilities taken over at what? Net book value. Liabilities taken over at the net book value. So let us start with the asset taken over at their net book value. Note number 7. Property, plant, and equipment was taken over. The first one is the property. Property, plant, and equipment. Property, plant, and equipment. But remember, not at the fair value. Number 7, we are given the fair value. Number 8, sorry, we are given the fair value. We need the net book value. Where are we going to get the net book value? From the statement of financial position, which is how much? The statement of financial position, it is that 1,750. That 1,750. Then the next one is inventories. Inventories also are taken over. And the amount is how much? 4310. 4310. Then the next one we have what? The next one we have account receivables. Account receivables. Account receivables. Account receivables were worthy how much? Account receivables were worthy 3840. 3840. They were worthy 3840. So from there, let us first deal with the liabilities taken over. Liabilities taken over. Liabilities taken over. We had what? 12% bonds. So we have 12% bonds. 12% bonds are amounting to how much? It is 12,500. Then when you go to note number 7, you are told, note number 6, sorry, you are told that the current liabilities of Taidi Limited were transferred to Stawi Limited at their book value. So we have the account payables, under current liabilities, and the account payables are worthy how much? It is 3090. 3090. Then the next one we have accrued interest on bonds. We have accrued interest. Accrued interest on bonds. Accrued interest on bonds were worthy how much? 750. We have 750. Then we have bank overdraft. Bank overdraft. Bank overdraft. How much was the bank overdraft? It was 2250. 2250. 2250. Then from there, also we are going to debit unrecorded liability. Unrecorded liability, it is the preference dividend. It is not recorded. So we are going to talk about the preference dividend. Preference dividend in arrears. In arrears. In arrears. They were worth how much? They were worth 2,000. 2,000. Then also we have the liquidation expense. Liquidation expense should be capitalized. So we have liquidation expense. Liquidation expense amounting to how much? Liquidation expense amounting to 6,000. Liquidation expense amounting to 6,000. Then, nevertheless, we need the purchase consideration. Purchase consideration should be credited in the realization account. So take the purchase consideration. So the purchase consideration was amounting to how much? 23,000. 23,000. That was the purchase consideration. Then let us see the amount that we will be taking to the realization account from these accounts. The amount taken to the realization account. So this is giving us a total of 12,000. It is giving us a total of 12,000. So here we have 12,000. So the realization account. The realization account is going to take how much? How much will go to the realization account? How much is going to the realization account? The difference is 1,000. 1,000. So it is on the debit side. When you bring on the realization account, should be on the credit side, and the title will be preference share capital. So it is the preference share capital. Preference share capital is 1,000. Preference share capital is 1,000. Then let us balance the ordinary shareholder sundry members account. When you add this, we have 22,000. This is 22,000. Let us see. We get how much are we taking to the realization? Realization account will be how much? It will be 22,000. Then we less 6,000. Then we less 4,800. Then we subtract 5,890. So in this case, we will take 5310. 5310. Again, it is on the debit side. When you take to the realization account, should be on the credit side. So here we are going to have ordinary share capital. Ordinary share capital 5310. 5310. So I think that account is done and dusted. Let us see. Remember, what you need to know If all the adjustments are correct, the realization account must balance itself. If all the adjustments are correct, the realization account must balance. Let us start with the credit side. It is 12,500. Then we add 1390. We add 750, 2250, 23,000, 1,000, 5310. So we are getting the total of 47,900. The total is 47,900. Let us add the debit side. We see whether it is balancing. 31,750. We add 4310. We add 3840. Then 2,000 and also 6,000. So it is balancing, meaning the adjustments are correct. The adjustments are correct. And number A is done. That is how you are supposed to adjust number A. That is how you are supposed to adjust number A. Then let us go to Roman 2 and see what the examiner wants in part B. In part B, this is what the examiner is saying. That journal entries in the books of Stawi Limited to record the initial recognition of 8% convertible bonds and the right issue on 1st August 2022. So he wants us to have the right issue and the 8% convertible bond. So the convertible bond was in note number 5. Let us go back to the note number 5. Note number 5, you are told that the bondholders in Tahiti Limited agreed to be transferred to the new company on condition that the bond would be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bond was to be 8% per annum. Similar bonds with no conversion right attract interest at the rate of 10% per annum. Accrued interest on bond was to be paid immediately upon taking over. This question is very easy. It is very easy. It's a financial instrument. It is a financial instrument. And when we have said that under the financial instrument, it is going to give rise to a financial asset to one party and a financial liability to the other party. So in this case, we have done what? The holders have agreed to be transferred. So let us see this liability. This liability. This liability. How are we going to evaluate this liability? It is very easy. We are going to take the number of years, then we get the cash flow, or what we call the returns. Then from there, we need the present value interest factor, and then we get what? The present value. Remember, it is a convertible security, and being a convertible financial instrument, it is going to give us what we call the debt component and also equity component of this convertible security. So under this, we are going to invest for 3 years. We invest for 3 years. Remember, our cash flow, shillings will be in 1,000. And here shillings will be in 1,000. So we have 3 years before it matures. 2 and 3. So the cash flows will come from the coupon rate. The coupon rate is that interest rate agreement upon the issue of this debt. When they were issuing, they agreed on specific rate, and this rate is what we normally call the coupon rate. And then we have the market rate. We normally say that the market rate is the interest rate at the moment. So therefore, let us get the cash flow. The cash flow, how much was the bond? The bond was worthy 12,500. And it is going to give us the return of 8% every year. So it will be 500, then we multiply by 8%. So 8% every year, it is going to give us a cash flow of how much? 1,000. Then year 2, it will give us a cash flow of 1,000. But remember, it is maturing after 3 years. So after 3 years, once it matures, it is going to, you take the amount, we normally talk about the amount invested plus the return. So it will be 1,000 plus what was invested. So it will be 13,500. Then we are going to discount using the rate which we have been told similar bonds with no conversion rate attract the rate, the interest rate, the interest at the rate of what? 10%. So our discounting rate will be 10%. This is a kind of a firm, but is an FR question. So how do we get the present value interest factor PVFA? From the financial management knowledge, we normally say it is 1 plus R raised to negative n. 1 plus R raised to negative n. So in our case here, it is 1 plus this one, which is 1.1. Now it will be 1.1 raised to period 1. Remember, we are taking 3 years. So period 1, negative 1. So it is going to give us how much? The first case will be 0.9091. Then from there, you divide by 1.1 for you to get year 2. Year 2 is 0.8264. And then you can get year 3 by pressing equals, which is 0.7513. Then once you get that, let us get our present value here. Our present value in this case is going to be how much? It will be 1,000. Then you multiply by 0.9091. So the first case, we are going to have 909.1. The second case, we will have 826.4. Then the third case, you take 13,500, then we multiply by 0.7513. So this one we are getting, it is 10,142 point what? 0.55. Then let us get the total and round off to the nearest whole number. So the total we are going to get here, down here, this is what we refer as debt component. Debt component. Let us get the debt component. Our debt component will be 909.1. Then we add 826.4. Then we add 10,142.55. So our debt component, we round off to the nearest whole number, it will be 11,878. So we have 11,878. So let us get the equity component. Equity component. So the equity component will be the balance. Remember, the total amount was 12,500. So you get the difference. That is what is going to give you the equity component. So let us get the equity component. It will be 12,500. Then we raise the answer. So our equity component is going to be 622. Our equity component is 622. Once you compute that, now you can present that information in a journal entry. That information can be presented in a journal entry. So let us present that information in a journal entry. We present that information in a journal entry. So the journal entry. So remember, the question was journal entry to record the books of journal entries in the books of Stawi Limited to record the initial recognition of 8% convertible bond. So let us have the journal entry. Journal entries to record the initial recognition of 8% convertible bond. It is very easy. It is very easy. Remember, a journal entry has a debit and what? So we are going to have the debit and also we have the credit. We have the debit and credit. And therefore, our shillings here are in thousand. Our shillings here are in thousand. So from there, we start by writing off the previous bond. So the previous bond, remember we had 12% what? 12% bond. 12% bond was amounting to 12,500. Then from there, we are going to recognize 8% convertible bond. 8% convertible bond is going to amount to how much? You take the debt component. The debt component, it is 11,878. And also you are going to recognize the equity component. Equity component of 8% convertible bond, which in this case it is 622. When the debit side and the credit side must be equal. When we talk about the journal entry, the credit side and debit side must be equal. So therefore, in this case, when we accumulate the two, how much are we getting? We are getting 12,500, and those two will amount to how much? 11,878. Then we add 622. So again, it is balancing. It is 12,500. It is 12,500. So that's how you are going to get the journal entry. The journal entry. Remember, this is part B, and it is part B. We have done Roman 1. So we want to do part B, Roman 2. Part B, Roman 2. Part B, Roman 2. So let us do part B, Roman 2. Part B, Roman 2, this is what we are told. And the right issue on 1st August 2022. And the right issue on 1st August 2022. They need us to compute for the right issue. The right issue. The right issue, remember when we talk about the right issue, this is where you give additional shares to the existing shareholders. Where you give additional shares to the existing shareholders. So let us see how much was the share capital. How much was the share capital for the existing shareholders? How much was the share capital for the existing shareholders? Then we start with number 1. We start with the first one here. The preference shareholders were given ordinary shares. How much? Remember, the ordinary share capital is always reported at the par value. So now let us report at the par value. We report at the par value. We report at the par value. So these preference shareholders, the ordinary shares which they were given were worth how much? It is 10 plus what was paid to make it fully paid, the par value. So this plus this will give us what? Will give us 20,000. Then the preference dividend in arrears. the ordinary shares were fully paid. So the par value here is 1,000. Then from there, we have the ordinary shares in Tahiti. They were given ordinary shares. So the company paid a half and the shareholders were to pay their half. So this plus this is giving us a total of how much? Of 12,000. So let us get what we call the total share capital from our par value. The total will be 20 plus 12 plus 1. It is amounting to 33,000. 33,000. So our ordinary share capital, ordinary share capital will be shillings 33,000. But remember, our shillings are in million. So if our ordinary share capital is 33,000, how many shares are these? Remember, our par value. Par value was equal to shillings 10. So if we need to get the ordinary shares will be given by 33,000. We divide by what? By 10, which will give us 3,300. So the existing shareholders, we have how many shares? 3,300. And then let us go to note number 10. This is what we are told. Note number 10. Note number 10, we are told that immediately upon the takeover, Starway Limited invited its ordinary shareholders for 5 right issue of ordinary shares at an exercise price of shillings 15. So you are told that they were given 1 share if you had 5. So what about 3,300? They were given how many shares in this case? How many shares in this case? Let us see how many shares were they given in this case. So it is 1 out of 5, then you multiply by 33. It is 1 out of 5, then you multiply by 3,300. So they were given extra shares 660. 660. Then the examiner continues to tell us that they were given at an exercise price of how much? Of shillings 15. The average market price of the ordinary shares on the Cambright basis immediately before the right issue was shillings 20. The issue was fully subscribed. So this is where you give the shares, extra shares to the existing shareholders at a discount. So remember, the market price was 20 shillings per share, but we gave them at a discount of, so we gave them at 15 shillings. 15 shillings. So they need us to report this transaction. How are we going to record the journal entry? Let us have the journal entry. Journal entry on the right issue. Journal entry on the right issue. It will be very easy. Again, we are going to debit and also we are going to credit. And remember, our shillings are in thousand. Our shillings are in thousand. So we are going to make some money from the right issue. So we debit what? We normally say you debit cash or bank. By how much? It will be 660, and we sold to them at shillings 15. At shillings 15. So how much? It is 660. You multiply by 15. It is giving us 9,900. Then above there, we gave them what? Ordinary shares. Ordinary share capital. The ordinary share capital is always presented at par value. So it will be 660, you multiply by the par value. The par value was 10 shillings. So the ordinary shares will be 6,600. Then above the ordinary shares, we normally talk about the share premium. share premium, share premium. So we issued at shillings 15 while the par value was 10. So a premium of 5. So it will be 660, then you multiply by 5. How much are we getting? So it is 660, you multiply by 5, you will get 3,300. 3,300. So let us see the debit and the credit side. The debit and the credit side. So in this case, it will be 9,000. This is 9,900. Then this one we take 6,600 plus 3,300. So it is okay. It is okay. So we are done with part B. We are done with part B. What is remaining is for us to present the statement of financial position. What is remaining is for us to present the statement of financial position. So let us present the statement of financial position. The statement of financial position. Now it is what is remaining for us. It is what is remaining for us. For us to summarize that question, we present the statement of financial position. The statement of financial position. The statement of financial position is what we are going to present here. And for the case of the statement of financial position, we have done 99%. What is remaining is just to present here. Is just to present here. So what we have done is 99%. So let us present here the statement of financial position. The statement of financial position. So the company is known as Stawi Limited. The company is known as Stawi Limited. So the heading will be Stawi Limited. Stawi Limited. Opening. We are talking about the opening statement. Opening statement of financial position. Of financial position as at 1st August. As at 1st August 2022. As at 1st August 2022. As at 1st August 2022. Remember, our shillings are in thousand. Our shillings are given in thousand. So we are going to start with assets. And for the case of assets, we have non-current assets. Non-current assets. Remember, we go to note number 8. Note number 8, tangible assets were taken over by Stawi Limited at their fair values. Now, in this case, we report at the fair value. So we have property, plant and equipment. Property, plant and equipment, which is 29,200. It is 29,200. Then from there, we go to current assets. So for the current assets, we have inventories. So we have the inventories. Inventories were worth how much? It is 3,870. 3870. Then we have the accounts receivable. Account receivable was 3640. Then we made some cash at bank. How much did we make? We make an amount of how much? From the right issue. From the right issue, we made an amount of how much? Not the right issue, sorry. We made an amount of, from the sale of the shares, we had how much in total? The sale of the shares, if you confirm, our total was 16,000. 16,000, then we sold some, also the right issue. We sold some shares to the existing shareholders worth 9,900. Then from there, we paid some expenses. Like accrued interest was to be settled. The accrued interest was 750. Also, another expense which we paid is bank overdraft. Immediately the money kicks into account and you have the bank overdraft, the bank will just take their dues. Then also the liquidation expense, we are told the liquidation expense was settled. So how much was remaining? Let us see whether we have a cash balance or we have a bank overdraft again. So this will be 16,000 plus 99, then we less 750, then we less 2250, then we less 6,000. So we are having 18,900. So here is 18,900. We have 18,900. Then from there, we go to the equity and liabilities. So for the case of the equity and the liabilities, we start with the equity. Equity we have ordinary share capital. Before the right issue, the ordinary share capital was how much? The ordinary share capital was 33,000. Then we had the right issue. The right issue added 6,000 more, 6,600 more. So the total will be how much? 33,000 plus 6,600. So the total will be 39,600. The total will be 39,600. 39,600. That is what we had. 39,600. That is the total. Then from there, once we have that, we had the share premium. Share premium was how much? The share premium was 3,300. The share premium was 3,300. Then from there, we had this one, what we call the equity component. We had the equity component of 8% convertible bond, which was worth how much? 622. Then from there we go to non-current liabilities. So for the case of the non-current liabilities, we had what? We had 8% convertible bond. 8% convertible bond was worth how much? 11,878. And finally, we had the current liabilities. So for the case of the current liabilities, we had account payables. Account payables were worth how much? The account payables was 3090. Was worth 3090. Then from there, we will get the total. We have the total equity and liabilities. Total equity and liabilities. Total equity and liabilities. But before that, let us see whether we had a capital reserve or goodwill. A capital reserve or goodwill. Remember, we said that how do we get the goodwill? The goodwill from the partnership knowledge or from the group knowledge is always given by what? Is given by the purchase. Purchase consideration. Purchase consideration, then you raise the net assets. Net assets acquired. Net asset acquired. That is how you get the goodwill. So let us see whether they had a goodwill or capital reserve. So let us first take the purchase consideration. The purchase consideration was 23,000. Then we raise the net assets. Let us compute the net assets. The net assets were worth how much? Let us have our net asset. The net assets. So the property was how much? It was 29,200. Then we add inventory. Inventory was 38,70. Then we add account receivable. Account receivable was 36,40. So the total assets, in our case, our total assets were worth how much? 36,710. Then also let us compute the total liabilities. Total liabilities, so that we can get what? The total liabilities for us to get the net asset. The difference will give us the net asset, or what we call the equity. So we have what and what? So the first liability we have is 12% bond, which was worth how much? 12,500. Then another one was this one, which was referred as to what? That is the accrued interest. Accrued interest of how much? Of 750. Then we add bank overdraft. Bank overdraft of 2250. And finally, we add the account payable of 3090. So our total will amount to how much? 18,590. 18,590. So our net assets will be how much? It is 36,710. Then you raise the answer. We are getting 18,120. That is the net asset. So we subtract here 18,120. Automatically the purchase consideration is more than the net assets, and therefore we are going to have the goodwill. Goodwill. Let us get the goodwill. So our goodwill will be given by 23,000. Then we raise 18,120. So therefore 23,000 minus the answer, we are getting 4,880. Then from there we will get the total. Let us get the total assets. Total assets. So our total assets will be how much? It is 29,200. Then we add. From there we can add also this one is 58,490. 58,490. Let us compute cash at bank again. Cash at bank again. How much do we have? Cash at bank again. It is 16,000. Then we add 9,900. Then from there we less 750. Then we less 2250. Then we less 6,000. And we are getting, this is not 18, but we will get 16,900. So let us compute our total assets again. We are going to have 29,200 plus 44, 48, 80 plus 38, 70, then plus 36, 40, and also plus 16,900, which will give us the same amount. We are getting the same amount. The same amount of how much? Of 58,490. 58,490. And that's all about the external reconstruction. That's all about the external reconstruction. In case of any question, kindly you can ask any question, and we are going to do many questions in class of external reconstruction. We had previously looked at internal reconstruction. So for the external reconstruction, this is how you are supposed to adjust. So the assignment, which I would like you to go and try, the assignment. Assignment will be August 2022. Question number, August 2022. Let me confirm the question number. August 2022 for the external reconstruction is question number 4. August 2022, this is question number 4. Go and try that question. That will be the assignment for the external reconstruction. It is as easier as you have seen. If you understand all the concepts and you are able to go step by step, it is easier. The question balances itself. Very easy. So that's all about the external reconstruction.